Moody's Analytics chief economist Mark Zandi joins us. Mark, a lot more people coming over to your camp, but the Fed's been late, at least when it comes to rate cuts. But we're going to still be waiting for September, right? They're not doing anything between now and then, are they?
No, I don't think so, David. Generally, the Fed keeps intermediate rate cuts to real crises when there's dislocations in markets, when trading breaks down, when banks stop lending. So I don't think we're anywhere close to that, and I think it would smack of kind of panic, desperation. I'm not sure what kind of response they would get. So I would at least at this point. I mean, obviously a lot of script to be written here. But at this point, the script doesn't say, cut intermediate. But when they get to September, it does feel like they should be cutting much more aggressively. And, the other thing they could do and probably should do is signaling through speeches and press interviews and everything else that they are ready to cut and they're going to cut and they'll do whatever's necessary to make sure the economy stays out of recession. But an intermediate cut, that I think they'll save that if something really goes off the rails.
Yeah, well, why don't you tell people again why you believe 50 basis points is more appropriate and why you have been calling for rate cuts previously?
Well, they hit their mandate, their target. We're at full employment, and in my view, inflation is back to target, appropriately measured. And even by their measure, we're back to target. And you can even argue with that 4.3% unemployment rate we saw on Friday that, we've blown through full employment. My estimate of full employment is something in the high threes, not 4.3, and all the trend lines suggest unemployment is going to continue to rise. So if they've hit their mandate, and then you got to ask yourself why, if that's the case, a 5.5% funds rate target. There's a lot of reasonable debate as to what the so-called equilibrium rate, that rate which is consistent with policy neither supporting or restraining growth. So I get that, and it's probably a lot higher than it has been historically for a bunch of reasons. But it's not 5.5% or even anywhere close. So they got to get the rate down to something closer to equilibrium, and that means 50 basis point cut in September, another cut maybe at in the November-December meetings. They got to get it down to around 4% here pretty quickly.
Do you think that the odds of recession, Mark, have gone up given Friday's jobs reports and given your expectation that they will only cut 25 in September?
Indeed, and I said 25 on Friday before today's market action. So maybe that if we see another, down 5-10% on the market and it starts showing up in consumer spending, which it very well may because high-income consumers are driving the train and they're focused on their stock portfolios. So. The conditions could change very rapidly, and they would go 50 basis points. But I think everything points to a much more aggressive rate hike. But I don't think rate cut. But I don't think recession. The economy is resilient, and the best measure of recession, far and away, is simply jobs, employment, payroll employment. And Thursday we were at 114K. That's obviously being affected by technical factors, Hurricane Beryl. We're probably underlying job growth 150K, 150,000 jobs per month. That's nowhere close to a recession. So I don't think that's likely. But having said that, they got to get moving here, and they got to get rates back down to something that's more consistent with their long run equilibrium.